Good morning and welcome to Stock Market Today. It's Thursday, July 18th, 2019. I am your host, Dan Russo, Chief Market Strategist at Chaikin Analytics. Find me on Twitter at DanRusso_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to ChaikinAnalytics.com/today. Sign up for a free email. Follow along with this show. Get daily stock ideas for you to consider hitting your inbox every trading day before the market opens. So U.S. equities closed lower Wednesday following mixed initial reactions to the early earnings reports that we've seen so far, down for a second day in a row. Defensive sectors outperformed with utilities and healthcare leading the way. Treasuries were stronger with the curve flattening. The dollar was weaker on the major crosses. Gold up nearly 1%, 90 basis points. WTI crude down 1.5% following inventory data. So utilities and healthcare, along with staples, tech, and REITs, outperformed. Underperformers, financials, comm services, materials, discretionary, energy, and industrials. As we get to the desk this morning, futures are down 10 basis points actually after closing near the lows of the session yesterday. Asian markets were weaker overnight, with Japan down nearly 2% and China off over 1%. European markets are weaker. Treasuries are stronger. The dollar is stronger versus the yen, but stronger versus the euro rather, but lagging the yen cross. Gold is off 10 basis points, giving a little bit of back after a strong move yesterday, and crude oil is up 70 basis points to get things going on a Thursday morning. Here's the market. We are above the breakout level, and we continue to hold above that level. Support 2,900 to 2,950. Resistance, let's call it now at the 3,000 mark. We've been dancing with 3,000 up and down for a little while. Round number, psychological resistance at that 3,000 level, likely to remain in play for a little bit of time. Now, should the market continue to pull back and test that support level around 2,950, we're going to look for the RSI to hold in bullish ranges. If the market tests and holds 2,950 and the RSI stays above 40, to me, that is a bullish sign from a momentum indicator, and that tells you that you want to go out and look for bullish and very bullish stocks in leading areas that have become oversold with bullish money flow. Now, money flow for the market in general remains positive. Down ticking here as the market closed near its lows yesterday and the previous day, but still holding in positive territory. So the indicators are okay. Market's taking a little bit of a breather here. I think it's pretty clear. Above support with RSI in bullish ranges, I think it makes sense to then get aggressive on the long side of the portfolio. Now, right now, in the here and now, stuck between 2,950 and 3,000 with some divergences in breadth that we're going to look at in just a little bit. I don't think you want to be as aggressive. You can sit back, do your work, and then look for better opportunities. So that's kind of where we stand for the market in general right now. Now, your market in a minute. Stocks pause for a second day in a row. Momentum breaks above key resistance. We're talking about the factor there. Breadth metrics turn mixed as short-term measures diverge. We'll take a look at what that means a little bit later, as I said. Global markets continue to underperform relative to the U.S., and futures, as I said, do point to a lower open here this morning, though it is slight, and they are off their worst levels from when I started my day. Looking at the Chaikin power bars now. For the major indices, the Dow 5 to 4 bulls to bears. S&P 500 holding in there, 134 bulls, 72 bears. NASDAQ still greater than 3 to 1 bulls to bears. 32 bullish or very bullish stocks for 10 bearish or very bearish stocks. Deterioration in the small caps, which once again underperformed. 515 bulls, 326 bears. Rally in bond sent yields lower. A little bit of a flight to safety with the sell-off in the market yesterday. According to the Chaikin Power Bar, large cap stocks and small cap stocks are bullish. Look at our stock of the day now. NXP Semiconductor, NXPI, ticker symbol there. Auto-generated based on that very bullish Chaikin power gauge rating, and that power gauge rating is due to very attractive financial metrics, very strong earnings performance, very strong price volume activity, and very positive expert activity. All four of the major factor categories are very strong or very bullish. So the fundamental setup is there, right? Very bullish stock. It's in a strong trend. It's in a strong industry group. But do we want to just run out and buy it? Absolutely not. We run through our process. And the process calls for holding off as far as I'm concerned. we talk about it all the time, market and model being in agreement. We want to see bullish and very bullish stocks that are outperforming the market. This stock is an inline performer to a slight underperformer. So right there, that would preclude us from really liking it on the downside. Now, it is oversold, but look at the bearish money flow. I don't like this. I don't like this bearish money flow. Above the trend line, consolidating. Now, we talk about these things day in and day out, but we now have our checklist where you can see them. You can check them off one at a time. Power gauge rating, bullish. Is it outperforming or underperforming? Underperforming. Is it in a strong industry? Yes. It is oversold. It is above the trend line, but money flow is weak. So for me, there's just not enough here to get excited about. There's probably better names out there in the semiconductor space that warrant our attention as we wait for a better opportunity in a name like NXPI. So that's the process that we run through each and every day when I'm coming up with my stock ideas for my morning note, or when I'm talking to clients and clients have questions about certain stocks that they own. We run through the checklist every day and we make sense. And we see if it makes sense to still own the stock, or if it's a name that they're looking at, to potentially get involved on the long side of the portfolio. Right now, I would say NXPI does not fit the bill. We'll add it to a bullish watch list and look for a better opportunity. Sector tracker, moving to the major sectors over the last 5 days. Last week, you heard me start to talk about materials, and they are at the top of the list for the past 5 days. Defensive properties and staples helping that group out. Discretionary doing well. Remember on Tuesday when we did our sector work, we looked at the breakout in discretionary on a relative basis. That continues to hold. Industrials and tech round out the top 5 that are outperforming the market. Comms, Utes, and financials are middle of the road. Healthcare, REITs, and energy, the bottom of the list. And it seems like week in and week out, we're here talking about energy being a group to avoid. That does remain the case. Stocks it's a bearish sector. The industry groups are bearish. When we look at the ETF power gauge ratings, a lot of bearish stocks. Just no reason to get involved there. Rather look for opportunities on the bearish side, or just avoid it altogether if you don't trade to the bearish side. Now, our industry in focus today, another one where we've been openly bearish, retail services, which over the past 6 months has underperformed the S&P 500 by 15.6%. Power bar ratio, which measures future potential, is weak with more bearish stocks than bullish stocks. You can see it here pretty clearly. 20 bears to 12 bulls. It's moved up one slot over the past week. It's currently ranked number 16 of 21 subsectors that we look at. So for me, at the very least, I know it's a group we want to avoid. If you want to look for names that might be compelling on the bearish side, Carvana, CVNA, Monroe Muffler, MNRO, and Advanced Auto Parts. Run through it. That checklist that we run through looking for long ideas, just flip it. Take the opposite approach, and when the opportunity is there, you can open bearish positions. Now, for me, here's a look at the ETF, XRT, the SPDR S&P Retail ETF. You can see here very clearly, bearish, Chaikin Power Gauge ETF rating, and in a weak trend. Been underperforming the market really since last October. Market and model are in agreement to the downside. Same rules apply here for an ETF. We want to see the market and model in agreement. We have a bearish rating, underperforming the market. Fund is currently overbought with bearish money flow. To me, if you're an ETF trader, you're avoiding this one completely. Also, if you're like to take bearish positions to hedge some of the longs in your portfolio, XRT actually looks compelling. Maybe you want to look at how the options are setting up, look at potential put options or bearish put spreads in XRT to take advantage of this trend, which is likely to continue to the downside. Taking a look at what's moving now in the S&P 500, yesterday's gainers and losers. Cintas, CTAS, up on earnings 8.75%. Hershey caught an upgrade, sent that stock higher by 3.75%. Abbott, earnings, up 3% on the day. ConAgra catches a little bit of a bid, up 2.9% on a lead paint settlement. Saw some headlines there, which investors took positively. And AMCR didn't see any real news to send that stock higher by 2.5%. Clear theme amongst the losers. First off, CSX, earnings disappoint, and they caught a downgrade, stock down 10%. Textron TXT, earnings sent that stock lower by 9.5%. Norfolk Southern, NSC, down in sympathy with CSX, and it also caught a downgrade. UNP, down in sympathy with CSX, also catching a downgrade. And the same can be said for Kansas City Southern. Those three stocks down 7.5%, 6%, and nearly 5% respectively. So maybe there's a theme here in the rails. All of them have very bearish ratings, except for NSC. So certainly looks like an area of the market that we want to avoid. Taking a look at our earnings update now. Yesterday's surprises. Progressive beat by 23 cents, but it wasn't enough. Sent the stock lower. eBay beats by 5 cents. Stock trading higher here this morning. Crown Castle beats by 11 cents. Stock does have a neutral rated. Bank of New York Mellon, part of the parade of banks reporting this week, beat by 7 cents. And Netflix after the close last night. U.S. sub numbers disappoint. Stock trading down heavily last night and in the pre-market today, despite the 4-cent beat. It's really those sub numbers that drive trading in the stock. Busy day. Thursdays tend to be busy. Before the open today, Danaher, Morgan Stanley, big names to watch after the close. Cap One and Mr. Softy, Microsoft, those stocks are bullish. Neutral stocks before the open, people are paying attention to Honeywell, BB&T, and UNH after the close, E-Trade and Skyworks. And then bearish stocks reporting today, Dover, DOV, GPC, and UNP before the open, ISRG, Intuitive Surgical after the close. Jay can suggest caution when holding bearish stocks ahead of earnings. So let's dive in, talk about look at what we're talking about in our note today. It's Thursday. We look at breadth. Now, what I would say about breadth is longer-term metrics are holding up, but shorter-term metrics are giving us some divergences that warrant attention. What we're looking at here is the percentage of S&P 500 above their respective 20-day moving averages. And what you can see is we have a negative divergence. These highs in the market recently were not met with new highs by this indicator. So it's a short-term breadth deterioration here in the market as we turn lower after not confirming at the highs. What I will say is the same goes for the percentage of stocks above their 50-day moving average. We have a similar divergence. However, longer term, the breadth picture still looks good, with the percentage of stocks above their 200-day moving average still trading near the highs and confirming the breakout in stock. So a bit of a mixed bag now from the breadth metrics that we look at. Advanced decline line still looks okay. Percentage of stocks trading at 52-week highs is neutral. Short-term divergences have caught our attention, especially as we talked about yesterday with the market overbought based on our proprietary overbought, oversold indicator. We do have a breakout in momentum, and that breakout in momentum is confirmed by momentum. We're looking at the MTUM, iShares MSCI US Momentum Factor ETF. Nice breakout here through the 120 level and holding above that mark so far. And what do we mean when it's confirmed by momentum? RSI solidly in bullish ranges, actually became overbought with the breakout. And notice that during this entire rally since the start of 2019, RSI never became oversold, routinely holding above the 40 or 50 mark. So this is what we talk about when we talk about that shift in the indicator to confirm a strong trend in price. We're seeing it here with MTUM. And on top of that, we've had some nice outperformance for this factor since the lows down here in April. So momentum, odds are that this factor is going to continue to outperform the market. Take a look for opportunities. You can either own the ETF when the setup is there, or look at some of the individual names that are holdings that meet the criteria following the process, whether that's a process that we advocate or whether that's a process that you've carved out on your own. But nice place to go looking for long ideas would be the holdings of MTUM. Finally, talking about global stocks, we're looking at the iShares MSCI ACWI ex-US ETF, and we can see here that it has not threatened new highs, right? S&P 500, US markets, with the exception of small caps, trading near highs. Global markets are not, right? We've got a little bit of a shift here in the RSI, but if we look relative to the S&P 500, steady downtrend. So US remains the best place for investment dollars as far as I can see right now. That's going to wrap it up for today. Head over, sign up for the email. I'll be back here tomorrow. Have a great Thursday.